CNBC and Fox Business are no different. They want you tuned in, and the best way to get you to tune in is to give you bad news and to instill some level of fear in you. Yep. Hello, thanks for watching The Money Puzzle. This is Eric Douglas with Aaron McAndrew. Yeah, sorry to stomp on you there. From Family Wealth Planning Partners. Thanks for watching. The topic for today is listening to the news media is not the same as doing your own research. So this is a very timely conversation for me, Aaron, because I literally just got out of a meeting where I was talking to the client about what our performance was doing versus the S&P 500. And it turned into about a 30-45 minute conversation about why the performance in the S&P 500 is not directly correlated with what's happening in your investments, because ultimately they don't own the S&P 500 directly. They own parts of the S&P 500, but they don't own the S&P 500 index directly. And I had to go into explaining the diversified portfolio and small caps versus large caps and all these different things, right? But it was very interesting to me because he was only looking and listening to what he was hearing on TV. And he's hearing certain things on TV about what the market's been doing over the last couple of months. And if you're watching this is the middle of May of 2023. So we've had a pretty good little rebound in the markets, knock on wood, so to speak, right? But obviously the markets were so far down from what they were last year that we've had a decent little rally, but by no means anything that I would call a rebound. Right. But yeah, your thoughts on that before I add to mine.
Well, for one, I think he's probably happy that he didn't own solely the S&P 500 last year.
Oh, we talked about that.
So that's some of the things, good, bad, and different. When the markets are up, you're going to see it on television. It's advertised right out there. When the markets are down, you're also going to see it all over the television. So, and also I would say, there's several people that don't even really understand when they see it on television what the S&P 500 is, or what the NASDAQ is, or what the Dow is, and they just look at it as, everything was up today, and that's not always the case either.
So it's funny you say that, because part of the conversation I had with this client was very specifically because he was asking, because he was looking, we have benchmarks on our performance reporting, right? And he was looking and he was saying, well, this is showing the S&P 500 benchmark. And I said, well, do you even really know what the S&P 500 is? And he said, well, it's just like the 500 biggest companies. It's like, well, yeah, it's 500 of the biggest companies, yes, but do you know what market capitalization means? Do you know how it's weighted? And you could just tell. We were doing a Zoom call, so this was a client that's not local to Louisville, but it was funny because we were doing a Zoom call, and I could very clearly see that I was starting to go over his head a little bit. So I very quickly tried to explain what market capitalization in the S&P 500, and this is how the S&P 500 is weighted, by the way. So as of today, the S&P 500 has a capitalization, meaning a total value of all 500 companies in the S&P. It has a total capitalization of about $34 trillion. The way that works, the way that the capitalization of it works, is that, let's say Apple, the biggest company with the largest market capitalization today, that represents about 7% of that $34 trillion. So every single S&P 500 index fund that you own, about 7% of that fund is going to be invested in Apple. Okay, that's the biggest holding. Right below that, you have Microsoft. Microsoft represents 4 or 5%, something like that. Then it goes down. Then you get your Googles and your Amazons, et cetera, right? The top 5 holdings in the S&P 500 represent about 20% of the total capitalization. So 5%, 5 companies equal about 20% of the total market cap. So it's very heavily weighted towards the largest stocks that are within the S&P 500. And so you could see his eyes just, I was trying to, and I had to slow down a little bit to make sure that he was receiving everything. But it was very clear that, the only thing that he knew about what the S&P 500 was doing was coming from CNBC. and articles that he had read online. And even he admitted very clearly, to his credit, that he was like, that's why I'm asking you the questions, because I don't really know about these things. And he also made the comment, this is why I hired you, right?
Right.
he didn't really know about the level of detail in all of his investments, but I use this as an opportunity to explain why we diversify portfolios and the value of diversification within when we're constructing a portfolio. So have you ever seen you've seen those asset class maps that they come out with every year, right?
Yep. Actually use them quite a bit when we do presentations to show the importance of diversifying for somebody who's either in a retirement plan or whatnot, that's choosing funds themselves and not just choosing the S&P 500.
Yeah.
And putting all your assets in that. So yeah, those are good tools. Yeah.
So what exactly do those asset class maps do? Because I pulled one up. I just Googled quick asset class returns, but I pulled up the very first one that I found. But real quickly, what exactly do they do?
It's a colorful chart or map, whatever you want to call it, that basically has each asset class in a different shade of color. And what it shows is the best performing asset classes of the year and the worst performing asset classes of the year, and it goes back several years. So what it points out real quick is because it's color coded, you're going to have, pink on top one year, and then the next year the pink's in the middle or the pink's at the bottom or, whatnot. And it's all over the map like that. But it shows that not one asset class consistently performs at the top every single year.
Yeah, absolutely. And it even goes I was showing him very clearly, like, okay, when you look at large cap was one of the asset classes that was on this map. And in a lot of years, it was towards the top. It wasn't always number one, but it was towards the top.
Especially the last 10 or so.
That's what I was showing him. Yeah, it was going over the last 10 years. And so I showed him, when you look at that large cap, it was orange on this map. Mm-hmm. When you see that large cap orange box, that's the S&P 500, or a rough equivalent, if you will. That's not always the best performer every year.
Right.
So the S&P 500 this year is off to a pretty good start. But last year, in 2022, it had a pretty rough year.
Right.
And you compare that to a lot of the overlap. There's a lot of overlap between the NASDAQ and the S&P 500.
Correct.
The NASDAQ had an even worse year. The NASDAQ was down close to 30% last year. Yeah. And so, and this was a wonderful illustration for me to talk about the value of diversification within your portfolio. Because I told the client, I said, hey, you've got some of these emerging markets. You've got a little bit of international. You've got a little bit of large cap, but you also have some small cap and some mid cap. You even have some cash, and you even have some bonds. Yeah. They're not all going to directly perform in the exact way in correlation with one another. And actually, you don't want that. You want some things in your portfolio to zig while others are zagging. Right. And so it was very instructive for me. Once again, we have these conversations with our clients on a regular basis, but you can never underestimate sometimes the power of the news media, because they still come in, and no matter how many times you educate your clients and how many times you educate, just friends and family and prospects that come in the door, it's still so interesting to see how susceptible they are to what they hear on the news.
Yeah, and there's a bias. I mean, there's a bias there with the news media. There's a lot of times there's probably an agenda there with the news media and what they're telling you and explaining, what they show as news being out there. So there's definitely a bias. There's companies that they run ads for that, it looks like it's something that's legit or a good idea to do, and they make recommendations. For example, I'm going to bring up the gold ads that you see all the time.
All the time.
Just because it's on a channel that people watch all the time, they look at that as being a prominent source of their information. A
trusted news source, if you will.
Trusted news source, if you will, yeah. The trusted news source, and they gather their information from that, and now they trust that, and they think, well, if so-and-so's doing it, and then they'll bring other celebrities in about doing certain things too, and if they're doing it, then we should probably be doing that, and that's just not the best way to get any of your information. It's certainly not the best way to do research.
Yeah, not at all. And it's funny because you were seeing the same thing happen quite a bit a couple years ago during the Bitcoin craze, when you had celebrities on TV all advertising. What was it, FTX that went under with Sam Bankman-Fried. But you had all these celebrities getting paid all kinds of money to endorse and cryptocurrencies, and usually most specifically Bitcoin. That's usually the most popular one. And a lot of those same celebrities have been quite silent
right.
as you've seen Bitcoin just come back down to earth quite a bit over the last year and a half. Not to say that there's not value in it, and that's a whole other episode we can do at some other point. But you have to understand and you have to know what you're holding, and more importantly, why you're holding it. And I think you see this most with gold and Bitcoin, I think, right now. And right now, gold is a little bit more in flavor because it's gold's had a good year over the last year.
Right.
But so many times, I've had these conversations with clients that come in the door that are scared. They're scared about the market because they watch TV and everything is doom and gloom on TV, which, by the way, what are they trying to get on TV? They're trying to get ratings, right? So if it bleeds, it leads. The same thing works in the financial news media the same way that it works on your local 5 o'clock news. What does the local 5 o'clock news lead with? Usually it's some type of bad news because that's what gets people to tune in. CNBC and Fox Business are no different. They want you tuned in, and the best way to get you to tune in is to give you bad news and to instill some level of fear in you.
Yep.
And then they're going to do that, and they're going to cut to commercial, and you're going to see these gold commercials. They're going to tell you, this is the best way to fix what's going on in the market. If you're scared, we get it. This is the only asset class that's been around for hundreds and hundreds and thousands of years. And okay, well, you know what? Let's go back to that same asset class map that we talked about earlier,
exactly.
Right?
Yep.
Gold is a precious metal.
Mm-hmm.
Gold is an asset class. Some people can argue whether it's a currency and all that. And my response usually is, if you had all the gold in the world, what are you going to do? Where are you going to go to? What are you going to buy with it? Are you going to go to Target? What are you going to buy at Target with your gold?
Right.
And how are you going to get it there, first of all?
Yep. Well, we even had a client that we were working with, last year or 2 years ago, that had an IRA in gold. And, and even then, it's hard to unravel some of that when they admitted that they probably made a mistake doing this. So, there's just a lot of issues with what the media is putting out there, that gold information there. We're not sitting here trying to say that there's no place in somebody's portfolio for commodities.
Absolutely.
We're not trying to say that at all, but not for the entire portfolio. So,
well, I think that's what so often, and when you watch and consume media, the answer is always black or white. It's always all or nothing. When they're selling you these types of solutions, or you're watching these commercials, when you're hearing someone go on TV and talk about it, and then usually when they have guests on TV, there's usually some type of vested interest that you don't know about and they don't have to disclose.
Right.
That's another thing to keep in mind too. So it's always good to remember the source. But it's just very interesting. The only client that I've lost in the last year was someone who was so scared of the market volatility that she threw everything into a gold IRA. And there was nothing I could do, and it was an emotional decision to her. And I'm very understanding of the way that people feel about their investments, because they are they're very emotional.
Right.
But she logically could not comprehend or could not come to a place of understanding that moving everything that she owned into a gold IRA was not in her best interest.
Right.
But she consumed so much media that was designed to sell her a product that at some point in the day she succumbed to it.
Yeah.
I hope it works out for her. I really do. She's a wonderful lady otherwise, but it just kind of is what it is, and to some degree it's sad that she fell victim to some things that she saw on TV that were not necessarily designed for her in mind.
Right. Yeah.
So.
And the media will usually lead in when they have these so-called experts on. Also, they'll lead in with the little tags at the bottom that basically say the person's name. They may say predicted the last market crash, predicted the 2020 coronavirus crash or whatnot, predicted, whatever it was. And, the reality of it is if you are constantly predicting negative things, you're bound to get a couple of them right, but they'll stick to the ones that you predicted correctly, and they don't ever advertise the ones that you did incorrectly. So there's usually an agenda, a hidden agenda or something there on the immediate.
Broken clock's right twice a day. Yeah. And you do see that a lot in the news media as well. You have personalities, people in the investing world that have personalities. They're known as perma bears or perma bulls. They always think the market's going to go up, or they always think the market's going to crash. And they develop kind of a rapport or a brand, if you will, around, coming on TV and instilling or giving certain types of opinions. And they need to make sure that they're staying true to their brand. So once again, this goes back to understanding who you're receiving your information from, and understanding that the information that you receive on TV is designed as entertainment. It is not designed for your best interests in mind. It is designed as entertainment, specifically in a way to draw ratings, to draw viewers to the television screen in order to sell ads in the form of commercials. That is not the best place to go to get your research done and to come up with the best ways to invest. That's why you want to talk to someone who's a qualified fiduciary, who is looking out for you and has your best interests in mind. Well, thanks for watching The Money Puzzle. We'll look forward to seeing you again next week.